Hi everyone. We'll just wait for 5 more minutes to join and we'll begin.
Hmm. Hi everyone, we are facing a technical issue, so it will take a minute or two. We are starting our session in a minute. Thank you. A very good evening to all of you, and welcome back to our part two of TP series of our webinar. And our today's topic, as you all can see, is importance of transfer pricing documentation. We sincerely apologize for the little delay, but I think as much as I like this topic doesn't like me. It was not admitting me to the webinar, and therefore this slight delay. But anyway, we are back, and I welcome all of you again. Before we start this session, imagine taking a ride to Sheikh Zayed Road and passing by a stunning new skyscraper that catches your eyes. It's got everything to catch your attention and it looks like success. And now imagine that some officer from Dubai walks in and asks, "Can I see your structural blueprints?" Can I see your fire safety certifications? Can I see your elevator maintenance logs? The developer replies, well, we built it right. It looks perfect. Isn't that enough? Transfer pricing is no difference. Your intercompany pricing might look perfect. Clean calculations, market aligned rates, great intentions. But if there's no documentation, if there's no master file, no local file, no benchmarking, then to the tax authorities, it would just be an empty shell. In Dubai and in transfer pricing, looking good from outside isn't enough. You need foundation, documents, and you need to prove that it is real. So, welcome again, all of y'all. And I have with me my colleagues Astha and Niti, who would take you all through the nitty gritties of transfer pricing documentation. But before we begin, how about taking a recap from our previous session as a bonus for all those who were with us last time and for the new ones who might allow us to break some myths for you. In our last session, we broke 6 myths on transfer pricing. And I want to take you all again through all the myths so as to make sure that there are no myths which remain in this practice. Can we bring up the first myth which we broke, Astha? Are small or medium-sized enterprise exempt from transfer pricing practices, transfer pricing compliances? Let me tell this to you all. No one is exempt from TP compliances. Yes, for some it would be exhaustive. Some have to limit it to complying with pricing, but all your transactions have to be at arm's length price, and maintaining arm's length price is mandatory for all. Can we bring up the next myth, Asta? Is TP compliance necessary only for cross-border transaction? No. UAE is a unique jurisdiction where every domestic transactions has to be benchmarked, has to be at arm's length, and therefore we have to be mindful that even if all the entities are paying 9% tax, still TP is applicable. Next, Mitastha. Are settled transactions with related parties completely outside the scope of transfer pricing? I squared off the loan. I squared off the loan before my year end. Do I still need to comply with TP? Yes. Even if at year end there was no transaction outstanding, even then TP compliance would attract for the period during which the transaction was undertaken, and therefore you would have to make sure that the loan which you had during the year, even if it was squared off at the end of the year, you charge appropriate interest to that loan according to the terms and conditions of that loan. Next one, Asta. Do you think simply disclosing the related party transactions in the audited financial statements ensures TP compliance? Not at all. It's not the auditor's obligation to make sure that the transactions are at ALP. They would rely on a document which you provide them, which would be called as a transfer pricing policy. And therefore, I'm sorry to tell you, but your auditors would not be of a much help here. Can we get the fifth myth, Asta? Can businesses defer TP compliance until they finalize their year-end accounts? I'm sure all of you must be in the process of finalizing the year-end accounts. And for those who have not done TP, it would have been a real pain now to get this done. So you have your answer that while TP does trigger when auditors ask you to give the financial statements. That is when we realized we were supposed to do TP. But ideally, TP was to be done alongside your business and cannot be deferred until your end. And I want to bring up the next and the last myth for everyone, Astha, which is the topic for today. Is it true that UAE businesses don't need to maintain detailed TP records? If that was the case, we all would have not gathered here today. TP documentation is optional in UAE is absolutely a myth. And what is the fact, Astha? The fact for us is TP documentation is not optional. Taxable people must maintain appropriate TP documentation if certain conditions and thresholds are met. Having said this, keeping all your transactions at arm's length are a mandatory compulsion, and there is no relaxation to it. We all so now we all know what the myths are, and we have seen a biggest myth monster now. And now I would hand it over to Astha and Iti to take you all through the nitty-gritties of transfer pricing documentation, so you all know what comprises of transfer pricing documentation. Is there anything which has to be submitted to the federal tax authorities now? What has to be reported along with the return? Everything. You will get all your answers today. Over to you, Asthanati.
Thank you, Kinjal. Hi, everyone. Good evening. Let's understand what is transfer pricing documentation. What is like how it is important in UA. So let's imagine every great organization has a silent guardian, someone who keeps things in order, someone step will when storms hit, someone will protect when questions will arise. In our tax world, the silent guardian is the transfer pricing documentation. Yes, today let's meet our unsung hero, not in a cape, but in files and spreadsheets. Imagine you run a business with offices in Dubai, Singapore, London, any country that that you can imagine. Goods move between them, services are also shared, money changes hands, but everything happens within the same group. Now picture a tax officer comes and asks, why did you charge this much amount for the goods you have provided, for the services you have availed between your, let's say, Dubai and Singapore entities? Was it at arm's length? That's the moment our hero walks in. He opens the drawer, pull out the clearly labeled files and says, here's what happened, here's why we did it, and here's how it's compliant. It's cool, confident, and fully prepared. Everything that you would want in a hero that we see in our in daily movies. But even heroes need a mission. And that the mission come from the UA Corptex Law, Article 55. This article is an official call to action. It mandates business to prepare and maintain documentation that will explain that their related party transactions were at arm's length. So, what does our hero do? Let's understand. Let's break down his mission. Uh, it will demonstrate the compliance with the TP laws and regulations. It will show basically that rules and regulations what are in place that have been followed. It will justify the pricing between the related parties, and it will prove the logic and fairness. It will bring the transparency when tax authorities will ask the questions, will raise the queries regarding the transactions that you have entered into, mitigate the audit risk. It will the chances are very less if you have a proper documentation in place, then chances are very low that you will have penalties or painful adjustments. It's not just a paper, it's a shield against scrutiny and a map through the complexity of multinational businesses. So next time when someone says transfer pricing documentation, do not picture a boring stack of papers. Picture as a well prepared professional who is walking confidently into an audit room and standing between your company and the risk risk of what? Risk of getting penalties and painful adjustment, and justifying the transactions and its arm's length pricing. So now my colleague EP will make you understand the TP documentation framework. Over to you, EP.
Thank you, Astha and Kinjal, for this energetic start. We really needed it. So now I request you all to get yourself seated properly because we are going to sit in a rocket today, go above the globe and see the satellite view. Then we will come down a little bit and see the drone view and then the street view. Before that, I want you all to imagine something. Imagine giant companies like Netflix, Apple, Microsoft sitting at different corners of world and reporting their transfer pricing transactions. But here's the catch. Every country wants the story to be told in a different way. They may have different regulations, different way, or even different thresholds to report transfer pricing transactions. it will be challenging, right? Here's That's where our hero transfer pricing documentation steps in. It is basically a global tax language uh, which helps the MNE to be transparent, compliant, and consistent. And so today I will take you through OECD three-tiered transfer pricing documentation framework and its interplay with UAE. Don't worry, it is not going to be a tax textbook. We are going to be take this session in a very joyful manner. So whenever I think about OECD framework, a question always pops up in my mind that why does this regulation came? Was the transparency or uniformity were the only reasons? So the answer is that after the financial crisis, tax authorities began demanding more transparency from multinational enterprises. Why? Because government were losing billions in tax revenue because multinational companies were literally shifting their profits from high tax jurisdiction to low tax jurisdiction. They were doing it legally. And as a response, in the year 2015, the OECD, along with G20, came up with BEPS action plan. What is BEPS? BEPS is basically base erosion and profit shifting. The aim of these plans was to reduce the profit shifting and base erosion. One of the measure of BEPS action plan was OECD three-tiered TP documentation, which you can see in the present slide. In this solution, they provided three layers, which are CBCR, master file, and local file. This three-layer documentation system was designed to increase transparency, prevent artificial avoidance of profit, and to increase the uniformity among different tax jurisdictions. So it is the time to sit in the rocket and go above the globe and see the satellite view. So what do you see? You will see oceans, different countries, different continent, seas, maybe Antarctica, UAE, India. So this is what country by country report is. It will tell about multinational enterprises in a broad manner. It is just like a scorecard in which you are going to tell about that how much revenue, how much profit different jurisdictions earned, and what was the substance in the different jurisdictions. So when does country by, before getting into the details that when CBCR applies, I want to discuss the threshold limit. It basically applies to big multinational groups with consolidated turnover of 3.15 billion AD or more in the preceding financial year. So it does not apply on every multinational group, but the big league players. Asta, can we move to the next slide? So what does the CBCR include? CBCR includes financial information. We have to report the revenue and profits incurred across different countries. So in CBCR, we have to provide the revenue and the profit jurisdiction wise also. The other critical factor which we report into CBCR is taxes paid. The tax authority wants to see that on how many turnover you have paid how much taxes. So we need to also submit that the amount of taxes paid jurisdiction wise. Then the other requirement comes up, which is regarding substance requirement. The tax authority really wants to compare that what revenue you have earned on what basis. So they want to get into deep details and see the substance requirement. And whenever we talk about substance requirement, the most important thing is to see tangible assets and the employees. We have to report the information and the amount information regarding tangible asset in each jurisdiction. Then the employees run the company. So we need to see that how many employees are being allocated among different jurisdictions. Under CBCR, we also have to provide the information regarding business operation. That is, we need to provide the description of business operation conducted in each jurisdiction. So basically, this report helps tax authorities quickly spot if income is being shifted from high tax jurisdiction to low tax jurisdiction without substance. Asa, can we go to the next slide? Now, we have seen the satellite view that how the M&E operates across the different jurisdictions. Now it is the time to go a bit lower and enter into Earth's atmosphere again and see the drone view. So what does a drone view look like? We see buildings, tiny buildings. We see tiny people roaming around the streets. So in this case, master file is just like that. It is just like a global book in which you will narrate that how business work, how decisions are being made, and how you can justify your profits. It applies only when the turnover is 200 million dirhams or more, or in a situation where your M&E group is already being covered by CBCR requirements. So the major components of master file are, firstly, you need to, the tax authority is really interested to know about organization structure, that which entity is reporting to which entity, what is the exact structure, how many entities are there in the structure. So they want to get an overall idea that how the structure is being made. Is the structure being made for getting some tax benefits? So from that purpose, this requirement of reporting organization structure is being introduced into master file. Then we have to describe about the business, a summary of the group's core activities, that how they make money and where they make money. The next crucial element is intangibles. Under this head, we report the existing intangibles in the groups, like IP, software, or it could be a license. Then we have to tell that who is the owner of the existing intangibles. So this requirement is basically brought into master file so as to see that whether development of a software is done by one entity and the ownership is being transferred to another entity which is based out of tax haven, just to reduce the tax liability. For example, suppose there's a company in UAE and its holding company is in Cayman Islands, that is a tax haven. So the UE entity and the companies are are engaged in IT sector. UE puts the effort to develop that software, but the ownership of that software is being held by the Cayman Island. Now the UE entity is paying royalty for using that software to Cayman Island. In that case, in this particular case, the profits are being shifted from UAE to Cayman Islands in form of royalty payment. So tax authorities want to detect such transactions and basically see that whether all the transactions are being held at arm's length basis. The next major component comes financing arrangements. Finance is the blood of every organization. So the tax authorities wants to see the source of the finance in the group. They want to know about the intercompany loans or any guarantee. Are interest rate being charged on intercompany loans is at arm's length or not? The last but the most important component of master file is TP policy. It is basically a summary of M&E Group's business operation and overall TP documentation. It is kind of high level explanation of how the group handles pricing between its entity across the countries. So it is the document anyone can see to just to analyze that how you have determined that the transaction is being done at arm's length basis. The goal of the master file is to show alignment between functions, asset, risk across the group, and there is no shifting of profit. Asta, can we move to next slide? So this is the drone view, which is equal to the master file. Now it is the time to land and see the street view. Now we are on the land. What do we see? We see buildings, streets, roads, people roaming around. We can have the vision, a limited vision of the local area. In the same way, local file, we do see information which is related to a particular entity which is local. A local file, you can say it is just like a personal diary in which you write about yourself, your life, that how things are going on in your life. In the same way, in local file, we do report the local transactions. Local transaction as in the information about the entity. So the threshold limit for local file is same as the threshold limit for master file. That is, if the turnover is 200 million dirhams or more, or the M&E, its M&E group is already being covered under CBCR requirements, then the entity is required to file local file, prepare local file. So, what are the major components of a good local file? The first one is entity details, that who manages the entity, what is the structure within the entity. After this, we do provide information related to functional analysis. It covers the information related to how does this entity actually do, what risk does it take, what asset does it own or use. So it basically provides a mini business profile with clear roles and responsibilities. The other component of local file is transactional detail. The transaction details are your intercompany transaction like payment for services, sales of goods, or maybe loans, etc. Then we need to provide financial information, that what was that you need to show the data at the transaction level, that how was the amount was charged, how much was paid, where it appears in the accounts. Again, the most important component of local file is benchmarking. Benchmarking um, is just like to where we are justifying that the pricing of related party transaction by comparing it to what unrelated parties would charge. In this document, we basically write down the prices of all the unrelated or major or similar or exact unrelated transactions, and then we show that our related party transactions are being undertaken at a price which falls into the limit at which unrelated transactions have been undertaken. So, for example, if your UE entity is paying management fees to its UK parent or buying software for its Singapore affiliate, you must prove that the pricing is fair, and you need to do it before the transaction is undertaken. Ideally, a benchmarking should be undertaken, should be made before the transaction is actually done. So this is all about CBCR, master file, and local file. I just want to give you a tip that whenever you want to, so that you can memorize about this requirement, just see CBCR as satellite view, master file as drone view, and local file as street view. Asa, we may go to the next slide. Yes. So we just spoke about OECD three-tiered TP documentation framework. Now we have to come to UAE local requirements. Is there any reporting requirement for related party transactions, even if TP documentation is not mandatory by law? So the answer is yes. Asta, can we go to the next slide? Yes. So, under UAE corporate tax law, it is mandatory for every company to disclose their related party transactions in TP disclosure form along with corporate tax return. So I want to ask a question at this point of time. If I am having a transaction with my related party of just AD 10,000, in that case also, do I need to report that transaction? The answer is no. The UAE tax law has provided me two tests to report these transactions. Um, and one thing more, this disclosure form does not require me to submit my benchmarking study or TP study, at least not yet. They just want me to tell them that what transactions are being occurred during the year and what was the amount of the transaction. Now we move ahead with the two tests I just mentioned. The primary test. For the primary test, I need to ask myself, did the aggregate value of all transactions with related parties exceed AD 40 million? If the answer is no, then there is no reporting requirement in TP disclosure form. But if the answer is yes, here comes the second test. The second test, we need to see the category wise. So we need to ask whether aggregate value of transactions per category with all related party exceed AD 4 million. If the answer is no, then we need not to report that particular category. If the answer is yes, then we must report that particular category while filing our corporate tax return. Here are the categories written on the screen. It may be goods, services, intellectual property, interest, assets, liabilities, and others. Now, Astha will cover various cases to explain where disclosures are required. Handing over to you, Astha.
Just before Astha begins, thank you, Iti, for giving us a new perspective of transfer pricing. The satellite view, the drone view, and the local view. No one would have thought about like this when they think of transfer pricing. You took us all to the space. And I think space and transfer pricing are a bit of related because both are complex and both are borderless. So thank you for taking us through this. Just to summarize what Iti just mentioned, three sets of preliminary documents which transfer pricing regulations focus on. One is CBCR, which is older than the UAE corporate tax law. The corporate tax law came in 2023, but CBCR filings were done much before that in UAE for the MNEs group. So it is older than the UAE corporate tax law. And the compliance attracts for the MNE groups. So those who are not MNE, they are relieved from it. The next two missiles which are there, local file and master file. These two are very new concepts to the UAE, and not everyone is aware in the form and fashion in which these documents are to be maintained. But as Iti rightly said, master file is a satellite view. It would cover what your organization looks like, what your organization structure is, where all are you present. So that is a satellite view of your organization, which you document in your master file. And when we go to local file, it is all the basic things which you do in your day-to-day business. Who is exchanging emails? Who has the authority to make decisions? Who is handling which functions? All these comprise of your local file. So even an email which is sent by one person to another person in your organization, even that document can be your local file. Of course, it goes without saying all the agreements which you maintain for your related party transactions, all the benchmarking reports which you have undertaken for benchmarking your transactions between your related party, all these documents comprise of your local file. So yes, all these are to be maintained and kept. There is a limit, but I would say that local 5, although there is no limit to it, but those are your regular transfer pricing documentations which you anyway maintain, and therefore, without any limit, also you will have to store this. Now I know that there are too many numbers which are involved, there are too many transactions which are involved, and therefore Astha is here to help us with some real life case studies, how and what needs to be exactly done. Over to you, Astha.
Thank you, Kinjal. Thank you, Iti, for this explanation. So before we move forward, we have some question answer session for you. It'll just three questions we have. We will answer. We will ask you the question, and please drop your answers. It's just MCQ. You please drop your answers in the comment section. So let's test your knowledge. That what have you learned in the till now in the session. So the first question for you is, when is a taxable person is required to fill the TP disclosure form? Is it only when primary threshold, that is AD 40 million, is met, only when secondary threshold of AD 4 million is met, or when both primary and secondary threshold together are met? So please drop your answers in comment section.
I think the majority of the votes are towards C, and I'm very happy to see that the audience is active, the audience is live, and the audience is listening. Majority ones have answered C. So, Astha, can we break the news? Yes, everyone
Yeah.
knows TP here, I think.
Yes. So yes, it's true because we have to meet the both threshold. First, we need to check primary threshold, and if it is met, then we have to again check at whether secondary thresholds are met. If this is the true, then only we need to report those transactions. Let's move further. Let's have a second question. A taxpayer has AD 45 million of total related party transactions with AD 3.6 million in goods category. It can be any transaction, purchase, sale, basically classified under the goods category. Do we need to report this transaction? Please give your answers in comment section.
Again, majority have answered B.
Right. It's a B. You do not require to report those transaction. This transaction. Why? Because primary threshold of 40 million, that is in total, if we total aggregate value of the related party transaction is going beyond the 40 million, but individual threshold per category wise, that is a 4 million, is not exceeding in case of this goods category. So that's why we do not require to report this transaction. Let's have another question. A taxpayer has AED 38 million in total related party transactions with AED 6 million in service category. Do we need to report this transaction? Tell us in the comment section.
Majority have said A, Astha.
No, it's no. Though individual, we have to see hierarchy wise. First, we need to see if primary threshold is met or not. If that is met, then only we need to check the secondary threshold. So again, in this case, primary threshold is not met. It's a 38 million, which is less than 40 million AED limit. Even if it is the, even after this, any transaction category is exceeding the 4 million threshold, secondary threshold, then also we do not need to report these transactions along with our CT documentation. So let's move further and have a look at the example with the some numbers. We'll understand this in better manner. So let's understand how it works. So let's have example of company A and company B. They are having the list of transactions as you can see in the screen. So they are having several transactions, and which we have categorized like the goods category, service category, interest, assets, and IP and other category. So now you will see that why this is the other category for the reimbursement for expenses. You many of you can have this question. So to answer this question, uh, usually this kind of expenses are for the category of either services or goods and reimbursement, like another related party has paid those expenses for you and you are reimbursing those expenses. So why we have not classified this in the category of goods or services? Because if it is a reimbursement, that it will be the pass through nature, it will have no service element, no any other element. They are just incurring on behalf of you without providing any major services. That's why we have classified this as a other category, not in any other category. So we have kept it separate. Now let's understand uh, the total transaction. As we can see that its aggregate amount is around AED 19 million. Now here's the key point. The threshold is for mandatory TP disclosure is aggregate total related party transaction exceeding 40 million AED. Since company A's transaction, as you can see, do not exceed this threshold, there is no disclosure requirement. Even if some individual transactions, if you can see that goods category transaction, they are exceeding the limit of 4 million, that is a secondary threshold. Even in case of you can see that machinery purchase, that is again it's exceeding the 4 million secondary threshold limit. But why? Because the prime, as we have already know answer to this question, because the primary threshold of 40 million was not crossed. This means company A is not required to disclose any of this transaction in their TP disclosure form. Now let's move forward further for the company B. So, which has a significant larger transactions. If we total up these transactions, then it's around AED 685 million. This is well above the AED 40 million aggregate threshold. So, TP disclosure requirements are triggered. However, that doesn't mean that they have to disclose each and every transaction. That's when category specific threshold of AED 4 million comes into play. Let's see how. In case of purchase of raw material and sales of finished goods, both are related to the goods, though they are of a different nature. One is related to the purchase and other is related to the sale, but they will be classified as a goods category, and when combined this category, it's exceeding the 4 million, because it's totaling to 650 million. Sorry, 600 million. So it, which is more than 4 million. So we have to report both this transaction. Now moving further, there's an availment of technical services they have paid, and for availing the centralized accounting services. So for both will be classified as a service category. And again, when we combine this individually, this will not exceed the limit of 4 million, but those are pertaining to the single category. So we have to combine those transactions, and when we combine, it will exceed the 4 million secondary threshold limit. But let's see, interestingly, if you see, even the total exceed the threshold, certain categories of transaction are there which do not uh, meet the secondary threshold. Let's say payment of interest, it's around 1.8 million. If you see the royalty, it is also, again, it is a 1.9 billion, and reimbursement of expenses classified in the other category, zero point 0.7 million. Those are the those three category of transaction. They are not exceeding the 4 million threshold. That's why only goods category, service category, and if you see uh, liability, that is the repayment of loan, only this category of transactions are need to be reported. Why? Because there is a dual limit is there. So first we need to check the primary limit, and then we will see the secondary threshold limit for the individual category of the transaction. So just to summarize, for company A, since total related party transactions when aggregated are below the AAD 40 million, so no disclosure is required, even if some individual transactions exceed the AAD 4 million category threshold. For company B, since the total is above AAD 40 million, disclosure requirements are triggered, but only those category of transactions where transaction value exceeds the 4 million must be reported. Let's move further. This is not this are all related this all concerned to related party disclosure. Do we have anything related to the connected person's payment? Yes, we do have. So in case of a connected person, how it will work, let's see. Let me say this upfront, just thing that if you are having payments to the directors and so on, so those are the connected person. We have seen what will be the connected person in our previous session. You can refer to the session. So if we are having any payment, making any payments to those related party, and for each related party, if it is exceeding 0.5 million, that is 500,000 AAD, then we need to report those transactions. Now, let's say there is a one clause that connected person, we have to see this limit together with the related party. So now if you are having any payment to the director, let's say remuneration, but if you are not have, if you are having payment to some related party, then you need to combine those transactions and see whether it is exceeding 5 million, 0.5 million or not. If it is exceeding, then you need to report those transactions. So it's not like that if you are not if you have escaped from the related party threshold, then you can escape this as well. Maybe chances are there that you will get disclosure requirement will get triggered if connected person will have come into play. Let's have a question now. Again, let's have a some question answer. So to understand it better, let's have a question again. So now in this case, a company is paying director remuneration to it's a three directors around 200,000 AD 300,000 and AD 400,000. Whether disclosure requirement is triggered or not, please let us know in comment section. I think majority of are having answer B as the answer. Option B. Let's see how it is. It's correct. It's no. Because we have to see the limit per person. So these are the three different directors having director remuneration which is not exceeding 500,000 AED. So in this case, there will be no disclosure requirements. Let's have another question. So there are two directors of a company who are cousins. Each is receiving AED 400,000 as a director remuneration. Should these transactions be reported in the TP disclosure form? Please let us know in the comment section.
Majority answers are B, Astha.
No, this is not the case. The correct answer is yes. I'll tell you why. So if we see, we have to see the limit per person together with its related party. So previously we had explained that in previous section that how like these two directors, they are the cousins, they are related to each other by degree of kinship. So they will be treated as a related party, and if we club them together, they are receiving 400 each 400,000 AD each person is receiving. If we club them, it is coming around 800,000 AD, and combined payment is exceeding the threshold of AED 500,000, and in this case, both the transactions should be reported. So
Absolutely.
let's
And the definition of kingship, which is there in UAE law, is the widest we have seen because it covers up to 4 degrees. So we have to be really cautious when we are receiving any payments along with our related parties because the law has been drafted in such a way that it would trigger a requirement, disclosure requirement.
absolutely, absolutely correct. Let's go. Let's go now. Everybody will think like, I do not have any I do not fall under any documentation threshold. Do I even I do not have any disclosure requirements? Still do I need to maintain any documentation or not? Let's understand. So yes, let's just because you are below the threshold doesn't mean you're off the hook. This is one of the most misunderstood areas of transfer pricing compliance. The law mandates that all transactions with related party, regardless of the amount, even a single dirham, must be conducted at arm's length. The only variation lies in whether disclosure and documentation obligations are triggered based on the thresholds. Even if your company does not meet the threshold for documentation or disclosure, you are not exempt from the tax scrutiny. FTA still can initiate tax audit at any time, and when they do initiate tax audit, they can ask for the proof that say you have related party transactions of X or Y amount, and please explain whether they were conducted at arm's length or not. So that's when the real pressure kicks in. Some may ask, why prepare TP documentation in advance? Can't we just prepare it when FTA request or FTA demands for the scrutiny for only for those transactions which are scrutinized? So the answer lies in the 30-day deadline. Once FTA initiates an audit, the clock starts ticking, and preparing the robust documentation which can justify your transactions and their arm's length pricing from scratch within that time frame is too unrealistic and risky. Let's say if FTA sends you a notice tomorrow, and from that moment the clock will start ticking. You'll just have 30 days to submit the complete transfer pricing set of documentation that could include benchmarking analysis, functional analysis, TP policy that you have in place, intercompany agreements, then data summaries, or you can say that intercompany ledgers, vouchers, or invoices, basically any document that can prove that related party transactions were conducted at arm's length. Sounds manageable. Does this sounds manageable to you? Not really. Uh, Creating transfer pricing documentation is not just a cut copy paste job. It's a technical, time intensive, and often requires external benchmarking databases. Doing all that in just a 30 days timeline with having audit stress is really too unrealistic. So what could be the result if we say? Then you risk the missing the deadline, facing penalties, hefty penalties, and adjustment, dealing with the compliance failures. Because why? All because your documentation was not proactively maintained. So what's the smarter play? Maintain your files in advance, even if you are below the threshold. Treat it like an insurance. You hope you do not need it, but when you do, you'll be glad it's there, complete, accurate, and ready to protect you. Let's move further. So again, we have spoken a lot about the importance of preparing the transfer pricing documentation in advance. Now let's break down what the documentation actually looks like. TP documentation isn't just one report. It's a collection of interlinked documentation and evidence that together justify your intercompany transaction and its pricing. Let's go through each piece. First is TP study report. Understand this is like an anchor document, a comprehensive report which will analyze all your intercompany transaction. This will include functional analysis, economic analysis. What are those? These are the tax jargons. I know. Let's just right now understand this report will include functional analysis and economic analysis. What are these things we will understand in our upcoming sessions. Then it will also have a method selection and justification why you have selected any method to benchmark your transactions. Then conclusions on whether pricing is at arm's length or not. Think of it as a backbone of your transfer pricing position, the document that ties together your reasoning, analysis, and results. Next is a benchmarking analysis. This is where number meets logic. The benchmarking study justifies your pricing by comparing it to the similar transaction between unrelated party. It can be the internal also, it can be the external also. It will depend on the type of transaction that you are undertaking. But basically, it will have the all numberings from the quantitative backbone of the entire TP documentation. So without this, your case lacks the credibility. You should have benchmarking analysis in place. Intercompany agreements. So what are those? Are the formal contracts that you will execute between you and your related party. You will outline the terms, roles, pricing, and even risk sharing while conducting any specific transaction. So you can have the entire one document also in that is a master intercompany agreement in place also. And if it is not possible, then for per transaction, before entering into the any transaction, just try to analyze all these things, have your benchmarking analysis, then set the pricing, and then execute the formal intercompany agreements, because this is the very crucial. If you're and that should also match with the actual conduct, the actual transactions that you are going to incur. If your agreement says one thing, but your financials or your other documents that you are going to present before the FTA, it will say any other thing. It will show something different picture. Then expect the questions from the FTA. You will be questioned. So this should align with the other documents also. Now, functional and risk descriptions. Why it is important? It is a kind of a functional analysis that you can have. You can say before conducting any transactions, you should analyze that this is the narrative. It explains who does what, which party is owning what assets to conduct any transaction. What is the risk involved while you are having intercompany transactions? So this is critical for choosing the right TP method, supporting your benchmarking logic, and it will help the authorities to understand the substance behind your structure. So have the functional analysis. All these documents are required. Now let's say invoices and voucher. Why they are important? These are proof points. It is the evidence that transactions actually happened, and they will validate the consistency between the agreed terms and what was the actually executed. So it will show the you can say that it will show the reconciliation between the intercompany agreement, that is the policy document that you are having in place, and what are the transactions that you are actually incurring. It will serve as a foundation for the ledger entries and ledger analysis. So now let's understand what is the intercompany ledgers. So these are the detailed records that will show the actual flow of transactions in your books between you and your related party throughout the year, any point of time. So previous session we had said that we have the loan settled down before the year end. So how FTA will get to know? They will get to know by the intercompany ledgers when they will scrutinize those. So at that point of time, it will come. If you have skipped this, then it will be treated as the non-compliance. They will coming back to the intercompany ledgers. So what will do? They will help and trace the reconcile group transactions with your financial records, as we have known. Then it will strengthen the audit trail and close the loop. So each of these documents has the distinct role, but together they will form a full story. When complete and aligned, this documentation will demonstrate the transparency, support the compliance, and reduce the audit risk significantly. Remember, more ready this documentation is, the less stressful any future FTA request will be. Let's move further. TP documentation, when we should file and what time we should file. So we have understood till this point time. Let's understand when is the requirement comes in. So for master file and local file, these are the core documentation under Article 55. But here's the important part. You are only required to prepare and maintain them if you meet the prescribed thresholds. They are not submitted proactively to the FTA, but remember, they must be kept ready and available. So when it should be kept ready and available? At the time of filing your COPTEX return. And once requested by the FTA, you'll get only 30 days to submit this complete files. So while they do not go out automatically from your side to FTA, the expectation is that they are fully prepared and ready at all times. Now let's go for the TP disclosure form. So this one is non-negotiable and it will apply broadly. The TP disclosure form must be submitted alongside your COPTEX return, whether or not you meet the above thresholds for the master file and local file. It will apply to all taxable persons regardless of their revenue. But yeah, definitely we need to see the primary thresholds and secondary thresholds that we have understood. We need to see that as well. And it captures the essential details of transactions with both related party and connected party, covering the payments, benefits, and terms. So to summarize, files, that is comprehensive reports, master file and local file, are maintained and submitted upon request. But disclosure form, that is a summary data, is submitted by default with every COPTEX return. This structure ensures that FTA has transparency at the time of return filing and depth of data when required. So thank you all. That's from my side. Now we can have questions.
Thank you so much, Astha, for this elaborated discussion which we had on the documentation. We'll just look at the chat box in case we have any questions. In the meanwhile, can you just display our QR code to join the group?
Sure.
So most of you all must know, but for those who don't, we run this community where we try to have a satellite view, a drone view, as well as the street view of taxes, and that to not just corporate taxes, but international taxes as well. So please feel free to be a part of our community and grow in this tax world with us. I do not see any questions in the chat box, and given that we have exceeded time, I think we can wind up. Um, just for everyone's benefit, there's a session next week too, and next to next week too. Next week, we will talk about most common UAE transfer pricing transactions, which we have seen. I have visas in one entity, my employee is working for another entity. I have working capital, which is flowing throughout my group because it's entirely my group, my money, so I can flow it anywhere. Then all those sorts of transactions we will see, decode in the next session. So please be there with us and join us for the next session. And the last session will be about most common practices in transfer pricing. It would focus on the benchmarking methods which are there and other main major concepts of transfer pricing. So we look forward to having you all in the next two sessions as well. Hopefully now we are clear on what the transfer pricing documentation would look like. So have a very good evening to all of you, and we look forward to seeing you all next week. Bye bye.